Great, and welcome back from lunch, everyone. Our next session is on cryptocurrency, so I'm going to dive right into that item on the agenda. So, although crypto has been around for over a decade now, the industry is still very new. The use of crypto is growing, with more companies getting involved and new use cases being developed. This growth in the number of industry participants and the volume of crypto assets amplifies some of the questions auditors have been dealing with for several years, and also generates new questions that may require more attention from various stakeholders. The May 2025 breakout session on AI included a robust but slightly shorter discussion on cryptocurrency, and we'd like to build on that momentum and continue the dialogue as part of this meeting. To refresh your memory, the report back of that breakout session in May highlighted the following. Overall, in the public company space, members noted that material holdings of crypto were not commonplace, although it was becoming more common than it had been. Beyond just holding crypto, other use cases include mining, staking, and lending and borrowing. As the industry continues to develop, members emphasize the importance of consistency in the amount of work done by industry participants to manage expectations of investors and other stakeholders. For example, on the auditor side, members highlighted that there may be diversity in practice across the auditing profession when it comes to addressing certain areas like ownership and access. On the company side, members highlighted that it is important to consider management's own obligations with regards to crypto in terms of COSO requirements and internal control requirements. From the audit guidance perspective, members noted the important work that has been done by the AICPA in developing a comprehensive digital asset practice aid, which provides detailed guidance in a number of areas. To the extent any additional guidance is needed to promote consistency and manage expectations of investors and other stakeholders, members suggested that the AICPA's existing guidance could be a good starting point. Finally, the breakout room highlighted the importance of staying aligned with the SEC and making sure that there is collaboration in this space among standard setters. So that's a brief overview of the discussion that was held in May. And again, we wanted to give that overview to refresh everyone's memory. With that said, as acknowledged by several board members in their opening remarks, there have been important developments in this space since May, which we now want to summarize. So in particular, on July 18th, the Guiding and Establishing National Innovation for U.S. Stablecoins Act, or the GENIUS Act, with new reporting and auditing requirements became law. The law requires stablecoin issuers to publish monthly reserve reports on their websites, and this monthly report must be examined by a PCAOB registered auditor, but the act does not require the auditor to use PCAOB standards. Additionally, stablecoin issuers meeting certain criteria must prepare annual financial statements in accordance with GAAP, and these financial statements must be audited by a PCAOB registered firm using PCAOB standards. With that said, oversight is in the hands of the stablecoin issuer's primary banking regulator and not the PCAOB. Additionally, on July 30th, the Presidential Working Group on Digital Asset Markets released a comprehensive policy report. Among its recommendations, the working group addresses the role of the PCAOB and AICPA in providing direction and guidance to auditors, stating that, quote, the principles-based nature of the PCAOB's audit standards and guidance published by the PCAOB, as well as non-authoritative guidance from the AICPA, have allowed auditors of public companies and broker-dealers to adapt traditional procedures to address digital asset tokens. As the technology and its use continues to develop, there may be value in additional or new standards to promote consistency in application and execution and help align regulatory and stakeholder expectations, end quote. More broadly speaking, the SEC's crypto task force, established in January of 2025, has continued to be active, and cryptocurrency features prominently in the SEC's spring 2025 regulatory agenda. Several auditing firms sent letters to the SEC crypto task force in which they discussed issues pertinent to audits involving cryptocurrency, including some of those mentioned in our breakout discussion in May. So in advance of today's meeting, we shared a series of questions with you for your consideration. We'd now like to open up the floor for a discussion of that first question, which Awilda, if you could put that on screen for us. And that question I'll read out. What recent developments have you seen in issuers' use of cryptocurrency? Are material holdings of cryptocurrency becoming more common? Have you seen an increase in use cases beyond holding cryptocurrency? For example, mining, staking, or lending and borrowing? And what developments have you seen in the broker-dealer space?
But by the way, I'm going to.
Oh, and
I actually don't know how many are online. They're not.
John White, you are, there we go. So if anyone wants to contribute with sharing their thoughts to that first question that now appears on screen, if you could please use the raise hand function. And again, for those of you who are only able to join for the PM session, if you click the react button, the actual heart portion of it, not the small arrow, you will see that raise hand function. So I will go ahead and open the floor for Stephen Rivera.
Yes, Danny, thank you so much. Look, this is, look, crypto is an evolving area for sure. And one area that really kind of got me a little bit concerned is the use of crypto to really kind of, I would say, used by companies in order to fund their own private, I would say, private equity. So let me, and I thought it was really interesting. The interesting thing is that we have kind of a lot of tension where a lot of companies want to go public, but the cost of going public is very difficult. So what's happening is we're having companies now using crypto as a way to actually fund their initiatives and basically almost circumventing the SEC. And that was, I thought that was pretty alarming to me to hear that that is like another way to actually, as a use case of potentially how companies want to actually fund their initiatives. So I guess, Danny, I just thought that to me, I'm such a maybe an accounting nerd, but to me, the use of what we do as accountants and CPAs and the use of public information and how we think about the SEC and 10Qs and 10Ks to circumvent that process by using crypto, and there's no governance over that, it is kind of alarming. And I saw it, and again, it's kind of bubbling up because of the fact that the cost of public and being a public filer, it does take money to do that. I get that, but that's another reason why we need more governance on crypto because of that. Because if you're going to see private companies doing that, then that's going to open up a Pandora's box of companies basically be like the Wild Wild West, putting information out there, and people will be investing in these kind of companies through crypto. So again, I hope that doesn't happen, but it's worrisome. And to hear that scenario being played out and being thought of, and circumventing what we do through the SEC and through public filing is concerning to me. So again, that's to me that's a doomsday scenario, but I can see it happening if there's no governance over this down the road. So again, so I have some more thoughts, but I'll open the floor for others to share their thoughts. But that's one that got piqued my interest a lot.
Thank you, Stephen, for that observation. I'll hand it over to Jamila.
Thanks so much. The broker-dealer space, the last question of these questions is what I want to comment on. They are big clients of Comply. And what they've asked us to do is create a cryptocurrency module where they can at least report all of their holdings and allow us to look into kind of how their holdings are doing. They will adjust what they believe to be the value on their own. We don't verify any of that, but we can provide benchmarking to them on, hey, this of your kind of peer set, this is what it's looking like for these particular type of, cryptocurrency assets. This is the valuation, average we have. So I think they're very interested in trying to, from the ones we're working with, trying to get this right and trying to have other sets of eyes on it beyond just them as the one custodian. So I think that's good. Hungry for more guidance, hungry for what more they can do. A lot of the broker dealers are appreciative of some of kind of what they see as relaxation around just strongholds on making someone declare themselves a qualified custodian and what that means. But they do want in the same breath, like a little bit of this is what you need to do to make investors feel good and to make the regulators feel good. And so that's been what we've been doing as we work with all these broker dealers as they continue to add more crypto on and want all these other set of eyes to tell them, yep, this looks good. This is within range. This makes sense. It's reasonable compared to your peers.
Thank you, Jamila, for sharing those experiences. Much appreciated. Brian Croto?
Yeah, thanks. So as we kind of look across our client base, I mean, we're clearly seeing an increase in the number of public companies with material digital asset or crypto holdings. I still would say that's a relatively small number, but yet growing. But we're also seeing an increase in varying use cases, including those that either are public or want to go public, and that includes things like whether it be exchanges or mining, staking, lending, lending and borrowing, tokenization. So I think we are certainly seeing an uptick not only in the holdings but also in use cases. And I should say, the bigger majority of what we see is actually in the private fund space, and that continues to be the case. That's historically been the case and continues to be the case, notwithstanding my prior comments. On the broker dealer front, I would say, as it relates to registered broker dealers, we've not to date seen material crypto holdings by our broker dealer clients. But having said that, that's evolving too in terms of at least some beginning to explore, and I think that may change here in the near term. But at the moment, that's certainly not something we've been seeing. So it's an evolving space, growing space, and I think that makes today's discussion particularly important because while it may not be a large number of companies subject to the PCAOB's oversight, their audits subject to oversight by the PCAOB, it's becoming a growing number, and obviously in an area where there's a degree of risk.
Great, thank you, Brian. Jim Freese?
Thank you. It's a broad question, so I'll mention just a couple of things. First, in terms of holding cryptocurrency, there's different ways of holding, as we know, and I think the most visible aspect is moving away from some type of self-custody or control to the increasing development of institutional custodian focus, especially with some of the traditional financial intermediaries opening up that function on behalf of others. As well as earlier this year, the removal of guidance in the last administration that would have limited the ability of banks to do it, or at least would have required them to give an advance notice to the regulators, that now opens it up more broadly to the regulated banks to provide those services. The second aspect, when you say the increase in use cases, I think it's very clear that we see a movement away from the mining towards especially the staking or lending aspect, usually one and the same, are very often related because lending is for staking purposes, but that's inevitable with the evolution from the proof of work model that we know from Bitcoin to the proof of stake model for the next biggest cryptocurrencies. And the last point I'll make is just on the broker dealer, something that you should be aware of is that many parties in the crypto space, so actors outside of the traditional financial system, are looking to acquire broker dealers or to have a broker dealer license so that they can provide certain services, especially anticipating some of the changes that will go forward if the next pending legislation in the Clarity Act goes through, clarifying differentiation of roles between what is considered commodities, what is considered a security, and therefore implications for dealing in those aspects. The last point that I'll make is tokenization. Basically a wrapper that takes a traditional security and makes it available, for instance, on atomic settlement on the blockchain. All securities are not the same, or once they're tokenized. For instance, some of the most popular models that are largely used for retail or cross-border access of securities now, because they do things such as fractionalize the securities, they break out the traditional governance and the voting rights versus the economic rights. So although the pricing might be off of the full share price with those governance rights, you actually don't have the same equivalent interest as if you had bought those shares directly. I'll leave it at that.
Thank you very much, Jim, for those insights and observations. I will hold the floor open for a second to see if there's any other hands being raised on this first point, which is really, providing updates on the lay of the land as it relates to crypto. Seeing nothing, Awilda, if you could go ahead and post our second set of questions here. So I will go ahead and read and summarize these. So we understand from information submitted to the SEC that the use of information from a public blockchain as audit evidence raises unique considerations about how an auditor evaluates the reliability of such audit evidence. So what specific additional guidance is needed by public companies and broker-dealer auditors when considering what is currently required by AS 1105, which is our audit evidence standard? The third question in our overall crypto questions, in your view, what are the top 3 or 4 areas where there could be notable diversity in practice when comparing procedures auditors are currently performing around cryptocurrency, and what auditing challenges could drive any such diversity? And then the last question, in May, the SEAG noted that any new guidance in the cryptocurrency space should build off of the AICPA's Digital Asset Practice Aid. Considering recent developments in this area, do you believe there are specific areas not already discussed in opening remarks today where the PCAOB should consider issuing such guidance? Further, we have not received a recommendation to this point in time from SEAG members for standard setting in this space, and it would be helpful for us to explore if that view has changed. So again, those are our second set of questions. So I will go ahead and open the floor to any commentary on this group of questions. Okay, great. Go ahead, John White.
Yeah, I'm not sure which group of questions this short comment refers to, but if I was looking at all of this from, 30,000 feet, I would have said that if you were thinking in terms of, auditor oversight and standard setting resources, that it is a much better use of scarce resources to devote them to artificial intelligence, which I think is applicable across the board and is a really big issue, versus crypto, which I must say, I don't think has the same kind of challenges or issues from an audit perspective. And so I would just generally urge you to be spending your resources and efforts on artificial intelligence versus crypto.
Thank you for that recommendation, John. Go ahead, Brian Croto.
Okay. Yes, maybe I'll try at each of your questions.
Thank you.
Yeah, and because I think there's a lot here. I don't disagree with John relative to the overall importance of AI, but I don't think I would do one or the other. I think there are some things I would do in the crypto space, and maybe I'll I'll come to that. It might be more narrow or discrete, and there's probably a lot to leverage from what the AICPA has done. But I do think for both the SEC and PCAOB, there are some important things to think about here that deserve some time and attention. So maybe on the second question about evidence, and obviously, the existing standard in 1105, I think, is appropriate relative to how one thinks about evidence. And as we think about that, we certainly, we think about information from a distributed ledger as audit evidence, and we've got, in our case, a tool that we'll use. There's also public tools that may be used, but you have to think about the reliability of those tools. In our tool, we do with that securely interrogate the blockchain, and that provides a degree of independent substantive evidence by pairing the private key and the public address. But when we think about like the extent of evidence and then the nature of evidence we're gathering, I think in this space there are some real unique and interesting considerations to be made, and I think the PCAOB has done a good job, and to some extent through the spotlight that was issued in 2023, I guess it was now. Some of that, though, I have to say, kind of came out of, in some ways, in our view, maybe the inspection process. And when we do have a scenario where there's an inspection, we do sort of wonder what the bar is, where the bar is going to be set relative to the way we've approached it in our policies and guidance, and what the AICPA standards or AICPA guidance says, because there's been a lot of thinking by the profession in the AICPA that's more public than anything the PCAOB has issued. So certainly that digital assets practice aid by the AICPA, I think, is highly important and relevant. And in particular, I think it's Chapter 5, the very first question, I think, in fact, really gets into the evidence point. And if you just stared at that for a moment, thought about that, is that consistent with the PCAOB's views? Is it not? And so I think really, whether there's some degree of endorsement of some of that or picking up some of that guidance or the like, I think it would be useful to have folks know in the context of a public company audit what the expectation is. As you look at some of the areas, and you've asked about areas where maybe it'd be helpful to have degrees of guidance or standards. I mean, one of the areas really goes to the existence of the digital asset when it's held by a third party. And when you're dealing with custodial arrangements, thinking about the range, there's a whole range of considerations, but when is a confirmation potentially enough in the context of materiality? How do you think about controls in that scenario? Where there's a SOC report, how long has it been since the last reporting? And I know those might sound like basic concepts that auditors are used to dealing with, but there is a good amount of guidance and thought that's gone into it from an AICPA perspective. And I think there may be a range of views among firms as to how far one goes, and to some extent, a range may be fine. But some of these topics deserve probably some degree of at least public vetting and clarity. And I think from an investor perspective, an understanding of how far an auditor might or might not go and what the responsibilities are, because I think some of it is a policy judgment to make, that obviously it's not just for the PCAOB, probably SEC and for companies to begin with, as you think about 13b2 A and B from a books and records and controls perspective. So that's the first one. Another one would be sole ownership. And when you think about, does access provide you, how much evidence does access provide you relative to ownership and rights? And so I think that's another one where there could be some ranges in views on how far one goes, because just because you have access doesn't mean that you have ownership necessarily, and multiple parties can have access as well. So and inappropriately or appropriately, and understanding those arrangements or those risks. Again, it goes to how far an auditor would go. From a management perspective, there's the question around safeguarding, which then extends to the auditor. And I think those questions are ones that you could have different policy views on as well. I think it's a little different than maybe thinking about just cash or inventory. Although some may say, look, as long as loss is accounted for, like inventory and shrinkage, if there's loss, you account for it, maybe that's sufficient. And others may say, no, there's certainly an expectation of a higher level of safeguarding in this space. So, there are specific rules for certain types of entities, like certainly if you get into the custody rule or the investment, or for investment companies, or broker dealers, if you even think about 15c3(3). But when you think about it from is it different for a company where there's an integrated audit versus not, or to what extent is safeguarding covered relative to ICFR and even 13b(2)(b), as you think through that, and again, we have to think about whether it's different for a PCAOB versus an AICPA audit. That's more for us than all of you, but certainly interesting to think about that as well. So I do think that there's a lot here, and it's not just about having clarity for auditors. I think it's about having clarity for investors and other users as to what the expectation is and what the risks are relative to it, because we can do a lot, or we can do something in the middle, or we can do something that's on the lighter end of some of those ranges, and probably make arguments as to how a wide range of that may be consistent with existing rules or standards. But having said that, that may not be consistent with the views that investors may have, and we may not have the transparency then as to what the obligation is and responsibility and ultimately the risks are. So I know that's probably a lot, but I just think that this is a space where there are some things that can be done. And back to the AICPA guidance again, I think if I were to start somewhere, it would be with chapters 4 and 5. Because really, as I think about those chapters, those are where maybe some of the more fundamental basic points are, and maybe that's just a matter of some leveraging of what's there. Or again, I'll say endorsing. I know that you don't just endorse something, but that, like, in some way there may be a way to kind of pick that up, or at least have some commentary that would suggest the views are consistent, or not if they're not. But I do worry that if we just sort of leave it to the first crisis that happens in this space, or we leave it to learning through the inspection process that some firms are doing it differently than others, and that's not consistent with the view, that's not going to be a good way to regulate this space. So again, I'll come back to John's point. I would not overdo it here relative to the time spent, but I do think there's some important time that needs to be spent.
Thank you, Brian, for those insights and recommendations. Jim Freeze?
Yeah, just adding on the earlier part of Brian's comments, the aspect of access and ownership are not the same. And particularly as we look at some type of a financial intermediary acting as some type of custodian, the different arrangements under which there's something that people may use the word custody are not all the same, particularly when we talk about bankruptcy remoteness. So you may not be able to just rely on the value of the assets. You might also be taking a credit risk on the entity that is helping you manage those assets. So again, different arrangements can have a very different potential valuation or risk haircut, or however you might want to look at. The other thing I just wanted to mention, because you teed it up not in the questions, but in some of the background, is the Genius Act, and something that people have raised, but I think will become more of an issue, is whether we consider stablecoins as equivalent to cash, because it's a relatively discrete issue, but also a pretty important issue when we talk about cash being king. And even as John White correctly says, this is smaller than AI. If we take just the projections of the Treasury Secretary that he expects this to be a 2 trillion market in a couple of years, that's not a small amount of cash. And we have some guidance just in the Genius Act itself that something, just because it may have the name stablecoin, only above a certain size of, let's just call it, amount in circulation, is subject to regulation, including this type of audit of the underlying. We also have a difference between onshore versus offshore stablecoin issues, including currently the biggest one in the world that is not subject to US regulation, although they're looking to create a modified version that would be under Stable Act, or conforming with the Stable Act requirement. So I think that discrete issue requires some oversight, because I personally would want to know the difference if a cash were kept in the way we talk about today, whether equivalent securities or bank accounts versus stablecoin assets.
Great. Thanks, Jim, for those insights and the classification observation. Stephen Rivera.
Yeah, Danny, I think your question in the chat was a really good one, and maybe kind of building off a little bit what Brian and James just talked about when we talk about company controls and financial reporting. Another big piece of all this is, for me, is valuation and impairment testing of these securities. I mean, when we look at the crypto, I mean, first of all, how they value it, it's all over the place. People use different techniques in valuing them, and there's different strategies in how they come up with market value. So, and then once you determine all that, well, then who's recognizing an impairment on these different models? And how does that even challenge the auditors, right? Because we have all these different fair value models that come up with these different crypto type of currencies. So the question is, you have a lot of volatility with these investments. You have different valuation models that are not standard, right? And then you have auditors trying to come up with the right financial reporting based on different models. So I see this really being really challenging, really difficult. So Brian, your point, it's ownership. Got it. That's definitely a big piece of it. But once it's on the balance sheet, what do you do, right? And it's, to me, it's a stew of stuff that really is really challenging for the auditor and for the preparer. And and again, that's why most companies I've seen have stepped away from it, just because of the fact that there is no standard model that we do today, and we look at equity investments and how we easily challenge, we adjust them based on fair value techniques that are consistent and standard. This, to me, is not standard at all, and it seems like every cryptocurrency is so different. So again, that's just something that I see really difficult to get my hands around, and then how you put controls around that. So I know Susan might weigh in on that as well, but it is definitely something to think about.
Great. Thank you very much, Stephen. So I'll move over to Kurt Schock.
There we go. Can you hear me? Yes, good. I'm glad that Jim Freeze brought up the distinction between stable coins and the crypto e-tokens that we've been talking about, because I think John White is correct that where and to what extent that the crypto asset, the e-token business is going to go is still, it's still struggling to get a passed final congressional rule on this. They're negotiating, all of the issues about, what it is, what's the rules around issuance, what the rules are around custody and safekeeping, and it, it may grow. But the bigger concern that our CFA Institute Systemic Risk Council had was that this stablecoin, these fully reserved payment stablecoins, do represent a pretty significant risk depending on how big they get, and they've gotten pretty big very quickly. And the issue about the reserve rules and how the stablecoin reserves are going to be tracked and verified and not gamed. There's a lot of concern about it has to be dollar for dollar of issuance. You have a dollar of cash equivalent reserves, and those will be some standards around what it can be invested in. But there's a lot of things that may creep into the formula for what is a cash equivalent for those reserves. And as a result, the Systemic Risk Council was concerned about making sure that that is, as part of the audit process, if it's a public stablecoin issuer, there's probably going to be, several private stablecoin issuers and state-based stablecoin issuers. So we're not, again, sure how big this business is going to get, but to have the right readiness and resolution process in place for runs. This is inevitable that there will be a stablecoin run of some sort. It's a confidence game, and whether and to what extent we've looked at those issuers, and they have at least some protections and readiness, and that there is a resolution process, which we've kind of outlined already, but it's a pretty complicated resolution process. And then 3, the whole concern about illicit activity, right? That's the biggest concern, given the reports that U.S. dollar stablecoins have been used in many ways to circumvent taxes and sanctions. And a lot of people have said, what do we use cash in society for? We use cash to be non-transparent about transactions. So many are concerned about that. And if you're an auditor of a stablecoin issuer that is now having stable coins out in circulation, in global circulation, you don't really have full understanding of how the coins are being used in commerce. Not fully sure of where the coins are and who holds them. We weren't very clear on whether that's going to be the case. So the question is, as an auditor of a large stablecoin issuer, whether you'd put that as a CAM perhaps. So just some thoughts. Thank you.
Thank you very much for those thoughts, Kurt. Sue Cosper?
So I just wanted to respond to Jim's comment, at least from a FASB perspective. We recently added a project to our agenda to improve the guidance around the classification of stable coins, particularly whether it qualifies as a cash and cash equivalent. And not to get ahead of that project, but I suspect what will come along with that will be some greater transparency on disclosure, perhaps presentation, yet to be seen. But at least in certain circumstances, I think we have acknowledged that we need to improve the guidance and the codification such that there's consistency in the way this is looked at and the way it's presented in the financial statements. And then I would just also say that we're I think later this month we'll be talking about another research initiative that's underway and whether we want to add projects to the FASB's agenda on derecognition of crypto assets as well as crypto lending.
Thank you very much, Sue. I appreciate those updates. Preeti Chowdhury?
Thanks, Danny. So I tried to do a search yesterday of like where crypto and digital assets were showing up in disclosure. And I found a number of cases where companies discuss them in the risk factors. I only found one CAM. I wanted to share that company name with you because it might be worth looking into to see if you think the issues they listed were complete. The company was T-Rex Acquisition Corp, and it was in their 2025 10K. So they had a nice disclosure of it's a CAM about the issue that was faced as well as what steps they took. And just related to the general issues, I think there is the ownership and control. There's also the completeness and accuracy of the reported balances. Wasn't exactly something someone had touched on yet, in addition to the risks of existence and the control and like security of the asset. And then another issue is also cybersecurity related to that. And that was something that wasn't mentioned, I think, by anyone else yet. But when I looked at that list and I looked at what the procedures were that this audit firm had done, they certainly had addressed some of those risks, but not all of those risks. And the second issue that I noticed when I was looking at the disclosures was I didn't find any company that had discussed crypto in their critical accounting policies. And given all the various valuation models and methods and how much judgment there is in there, I was a little bit surprised. I saw in the chat, somebody had mentioned, I think Bob had mentioned 135 companies were using crypto, but I haven't seen a critical accounting policy about it. And that is a little bit surprising to me if they are in fact material holdings. I'm not sure why that is. And that seems to fall kind of in between FASB and the auditor's role here because, the auditor, I think, should be checking to make sure that those are complete. But obviously, FASB needs to maybe have some rules that precede that. But those are some issues I noticed.
Thank you very much, Preeti, for doing that prep work and for sharing your insights with us. Let's see. Throughout the discussion, I have added a couple more questions in the chat function, just in case it assists with our discussion here. So I'll give everyone just a moment to ponder those additional questions that we shared, and also just consider if there's any wider points that they would like to raise for our consideration as it relates to crypto. Go ahead, Brian. Thank you.
At risk of staying my welcome on this topic. So, in addition to the comments on kind of chapter 4 and 5 and the things that the PCOB might think about, I'll throw out a couple more where I think the ASP has really not gotten to it yet so much, or they're in the process, and that could go to like the staked assets and revenues. I know it's a topic being looked at. The auditing of smart contracts, where there's sort of these self-executing digital agreements, and how we think about that in terms of the risks and vulnerabilities. You can have coding errors, there can be dependencies on external data feeds. There's all kinds of complexities to that. The evidence of the smart contract and what's sort of required that it's operating as it's intended. So there's I think a lot in that space. In addition, if you think about kind of DeFi protocols and sort of the auditing of the assets and transactions on a DeFi protocol, and there's a lot to think about there as well. And again, it's reliance on smart contracts. May sound basic, but making sure you have books and records and appropriate books and records to start from. And so I think those are probably just a few areas as examples. And I know that some of this, the PCB may not want to get ahead of things that are sort of evolving, and this space is evolving rapidly. But I do think, again, back to some clarity, because you can make some significant judgments from a policy perspective on how far to go. I think the CAM point, by the way, is a good one, because it is an area where I think through what we say in a CAM, where in fact in an audit it does rise to the level that you would have a CAM, which for material holdings on crypto we generally would, and certainly for significant use cases, we'll provide some opportunity for clarity to describe what we have done, obviously through the description of kind of procedures we performed, and in fact why it's a CAM to begin with. So that is something that we are spending time thinking about in terms of how that evolves over time, given in the public company space, it evolving now more rapidly. To date, it's been more of that had been in the private space, where we would not have had CAM reporting. So we certainly have had CAMs, and you would have a CAM relative to a very material holding on the other hand, even for in the public company space. But those are just examples of some areas, and I think there are others, and again, I still agree we're not at a point where the number of companies is so significant, although it's growing, but the dollar amounts we're talking about are growing, and we're seeing that it's space that, given the current regulatory environment, it will likely continue to grow probably fairly rapidly.
Thank you, Brian. Jim Freeze?
I just thought it's worth saying that a lot of the examples that we were giving before about companies and the exposure and what we'd be looking for in the audits was on the asset side. But I think it's important that we also don't forget to look at these from a liability side. So again, when we talk about custody, especially when it's coming into more traditional financial intermediaries that would have looked at securities as an off-balance sheet item, that now you might have on-balance sheet implications. Again, if you have some type of a risk or exposure versus really truly segregable assets in a bankruptcy remote setting. So it certainly works out when you have circumstances with borrowing or holding through some type of a staking arrangement. And it can be the example that Preeti gave of T-Rex, which is one of these specialized entities, but there's a few others that have essentially given up traditional business lines of activity using an existing corporate entity that now is just a holding for cryptocurrencies. But you also have big entities like a Coinbase that are fundamentally, again, questionable. What are their on balance sheet versus off balance sheet liabilities?
Great. Thank you for those additional considerations, Jim. Acting Chair Bodick?
Yes, thank you, Danny. A great conversation. I just maybe for my own edification, I'll say, and picking up, Brian, on some of your comments. I know you referenced the AICPA practice guide a couple times. And do you think this may be a broader question now because you may or may not know beyond your firm, but is the general view, I'll call it, that auditors are following the AICPA guide? And you mentioned a couple of chapters specifically. So the question is more so, using my words, what does the PCAOB think of that? Do we have different expectations or consistent expectations versus that firms are doing this differently? So there needs to be clarity because firm A versus firm B versus firm C may be approaching the ownership, as you mentioned, Brian, differently, or assertion or sole ownership, et cetera, evaluation, as Steve mentioned at the beginning, differently, versus, generally speaking, folks are doing it the same way. It's just a matter of what does the PCAOB think about that. If that makes any sense. I'm just curious.
It does.
Was wide divergence, or it's kind of generally the same with maybe a few differences here or there, and then it's what does the PCAOB think longer term?
Yeah, thanks, George. It's great to clarify that, and it's a great question. So I do think it's a mix. I think there are aspects of what's in the guide from an accounting and auditing perspective, mostly from an auditing perspective, from an accounting and auditing perspective, where I think there probably is a good amount of clarity and probably consistency in terms of, at least from what I understand, how firms that are involved in the task force are approaching it and in agreement. Obviously, every firm would have some degree of execution risk. That's a different point. Then, as you think about, look, there are other topics within, and some of them are the ones I sort of rattle off that I thought were most important to think about relative to sole ownership and safeguarding and those kind of concepts, where I do think it's easy to, at a principles level, kind of agree that you've got to do something and there's some amount of evidence, but then you start to get into, well, how far do you go? And we know that there are some differences because there are times when we interact with the other firms on client circumstances where one can determine, well, geez, we're doing something that someone else wouldn't, or vice versa. And we try to surface some of those through conversations with the AICPA task force. But I think there is some diversity on some important concepts on that front. So maybe that brings me to another possible recommendation, which I do think in this space, having whether it be a task force, you probably would want some folks, even that are involved in the AICPA task force, could describe that in a lot greater detail relative to like what the thinking was to get to the AICPA outcome, and then how their firms are thinking about it. In that kind of a setting, I think you could probably fairly quickly vet out where there are maybe some differences that then the PCAOB could decide, do we care about that variance or do we not? And I think at least a couple of those go really to the SEC in the first instance in management relative to their obligations and the clarity there that then the PCAOB would sort of follow on, presumably. But there are probably some that the PCAOB could directly have a view on, even aside from kind of the management perspective. So it's a great question. And I know we, and I'm sure other firms that have been involved in that task force would be really happy to do whatever we can to be helpful.
Great. Thank you, George and Brian, for that discussion and response. Stephen Rivera?
Yeah, Danny, one of the questions you asked is about audit committee member communication. And maybe it goes back to my early question on evaluation and impairment. Is like, I think audit committee members probably want to understand, the expertise from the auditors. I mean, I hate to put stress on the auditors, but they're not the experts on what's going on in this crypto market. So the auditors have to really have expertise and knowledge of how these things are working in order to present to the audit committee what those risks are to the company. So it's kind of a full circle, because of such volatility with these different kind of digital assets. Do they really understand what those risks are? And again, as an audit committee member, I guess they're going to rely on the auditor to help with that communication and provide that information. And it could vary from one digital asset to another if that company enters into something that they're not familiar with. So this puts I think it puts a lot of stress on the auditor and what we do, because how do you have to provide that information and try to understand how it works. And they could actually be very different depending on the nature of that asset. So so that's a communication I think it's really important for an audit committee member to be asking, and understanding why the company entered into these digital assets. What's the reason for it? I mean, what's the and again, just kind of asking the question, and that kind of, I ask myself, why would companies want to do this, and knowing some of the risks that they might be facing.
Great. Thank you for those observations, Stephen. And Barb, I'm not seeing any other hands raised at the moment. I'm conscious that we are running ahead of schedule, so I want to give everyone a minute here just to reflect on the conversation and see if there's anything else they would like to add.
And sure, while people are thinking, I just want to thank you at this point for a great discussion. And if you have thoughts after the meeting, I know sometimes you leave these meetings and think, oh, wow, here's the miracle thought that I should have provided. You know where to find us. We're happy to talk. You don't have to wait for the next meeting. Please don't save it up. Always happy to catch up with any members at any time. Well, seeing no other hands, we've heard a number of recommendations today, and we're happy to take those back. We have a lot of notes and a lot of thinking to do, and we consider all of your input as part of our continuous consideration of our research and standard-setting agendas. I want to take a moment to thank my colleagues, Wilda, Brian, and Danny, who work very hard behind the scenes and on the scenes to make these meetings possible and successful. And I see a hand up, so I'm going to call on Keisha.
Barbara, I was going to let you have your closing comments, and I just wanted to jump in just really quickly, if I may, as a point of personal privilege, because this will be my last time engaging with you all as a member of the SEAG. And so I've had a wonderful time having 2 terms on this. And so I just wanted to extend my thanks to the PCAOB board members, to the staff, and to all the colleagues that I've engaged with over my tenure on this group, and it's been fantastic. I've enjoyed it, but some of y'all know I have another role that is going to take a lot of my time, but I am not very, very far away, but just wanted to thank everybody for the opportunity to serve, and I look forward to future engagement at some other point. I'm quite certain a lot of you I see in other spaces and places. So this is just concluding this portion, but I will be around at some other point, at some other time. So again, thank you so much.
And thank you. And we won't hesitate to still call on you if we want to talk. So thank you for all your input, Keisha. Jeff?
Thanks, Barbara. I apologize for raising my hand late. After I saw Keisha raise her hand, I decided to put my hand up. So I apologize for coming in late, but discussing the AICPA guidance, there's 2 chapters of the auditing guidance that I think some investors and the firm should be interested in, that I'm not sure Brian mentioned, but chapter 1 on client acceptance and continuance. They have a section there on evaluating management integrity, and then chapter 3 on laws and regulations and related parties. I think both those sections have some interesting comments in the challenges specific to digital assets, and also the procedures to consider that are something I think, as I said, I think many investors as well as the firm should be focused on, particularly given, as some have mentioned, that we do know of one common use case for cryptocurrency, and that's to engage in criminal activity. Thank you.
Thank you, Jeff. And all very good considerations in those chapters. Thank you. And Jim?
Yeah, very quickly, I can't say it as eloquently as my colleague has said it, but thank you for the opportunity to serve 2 terms with this great group. I've also been invited to sit with the emerging issues in audit subcommittee and really enjoyed my time. And you all thanked us for our service on some kind of pro bono basis, but I'm also very grateful to be able to serve in some small way. So thank you again, Barb, and thank you to the board members.
They're very lucky to have you, Jim. Thank you.
Thank you very much.
Well, if there are no other hands, this concludes our meeting today, and we look forward to seeing you next year. Again, please don't hesitate to reach out if there's anything you'd like to talk to me about. I hope you all have a wonderful holiday season. I'm still struggling to believe that we're already into November. And thank you to everyone who attended and all of you who joined